So our first example is an Irish-controlled foreign corporation. And I've chosen Ireland because its corporate tax rate is below the 13.125%. So an Irish CFC with net income of $100 will pay the Irish corporate tax rate of 12.5%, leaving total earnings and profits of $87.50. For this example, its subpart F income is $20. That leaves us with CFC tested income of $67.50. Now, its plant and equipment, if you will, its QBAI, is $200. So the code allows for a 10% return on that $200. That allowed return, as you can see, reduces CFC tested income to $47.50. So the guilty income is going to be $47.50. Now, the guilty income only gets a 50% dividend received deduction, effectively taxing it at half of the current 21% rate. So this is how we get to our 10.5% tax rate. And there's an 80% foreign tax credit offset. Importantly, US individuals do not get any dividend received deductions. So continuing our Irish example, if you're a US corporate parent, your Irish tax paid, so your 12.5% of your $47.50 guilty amount, is $594. If you're an individual, it's the same amount. Your taxable income is the $47.50, the guilty. You get your dividend received deduction as a corporation. You do not get that as a US individual. So your taxable guilty for a US corporate owner is $23.75, for a US individual owner, $47.50. The corporate tax rate on the $23.75 of 21% yields $4.99, with an allowable foreign tax credit at 80%, so 80% of the $5.94 yields a tax payable of 24 cents. Now, importantly, we haven't made any distributions. There's no dividend being made up to the corporate parent to pay this tax. So your total tax paid on this $47.50 will be $6.18, an effective tax rate of 13%. However, for the individual owner, you're paying the individual tax rate of 37% on the higher $47.50 amount, the full amount. You get no dividend received deduction. You get no foreign tax credit allowance. And so your tax payable, again without distribution, is $17.58. Your total tax paid on the $47.50 then is $23.51, an effective tax rate of 49.5%. Now, if you're a UK CFC, your corporate tax rate is 19%. Your, again, the same scenario, your subpart F income is 20, your QBAI is 200, giving you an allowed return of 20%. Now, because you've paid a higher tax rate, you have less earnings and profits, and therefore less CFC tested income, giving you a guilty amount of $41. The same treatment will apply. So for the corporate parent, they will have paid $7.79 of corporate tax, whereas the US individual will have paid the same. The corporate parent will get a 50% dividend received deduction. They will pay 21% corporate tax rate, $431, whereas the individual tax rate is $15.17. They get no foreign tax credit as an individual, whereas they get $6.23 of foreign tax credit, leaving no tax payable for the corporation. And in fact, there would be a carry forward amount of the foreign tax credit. So the total tax paid for the US corporate parent is 19%, which is in fact the UK tax rate. There's no US tax payable. However, for the individual owner, their total tax paid will be 56%. So they pay on top of the 19% on this amount of 41, they pay the additional 37%. So What are the things that can be done with this? Well, one current structuring idea for, say, a U.S. individual resident in the U.K. who has a business in the U.K. and operates that business, and perhaps it's a consulting or an accounting business, it has very little plant and equipment, so it will have very little QBAI and not many opportunities to reduce its income for guilty purposes. One possible solution is shown here, and that of interposing a U.S. holding C Corp between the U.S. individual resident and the U.K. In this case, the UK business will be taxed at 19%, but there will be no corporation tax in the United States. And when funds come out of the corporation, they'll be taxed at 20%, assuming they're qualified, as well as a 3.8% net investment income tax, assuming that their AGI exceeds 200,000. In this scenario, we can also assume the U.S. individual is going to take a reasonable salary out of the business that they're running. This is really for their business owners' profits. Having taken out that salary, they also receive $104,200 foreign earned income exclusion. So, there was obviously a gap here between money that hadn't been taxed yet and the way money would be taxed, earnings would be taxed in the future, that $250 billion that we mentioned at Apple. So to facilitate this, a transition tax was imposed on all accumulated earnings and profits in these specified foreign corporations between 1986 and 2017. And at the end of the 2017 tax year, all accumulated profits are deemed repatriated. So it's as if they were brought home, but now they're going to be taxed in a very special manner. And this, again, is due for the 2017 tax year. The service has provided effectively a one-year extension, but this transition tax has caused considerable issues. So let's see how it would work. So let's say that your post-1986 earnings and profits that you held in cash, so the working capital of your business, if you will, is $100. Well, it's all deemed repatriated. There isn't a special allowed deduction, some call it a plug deduction, to bring the taxable amount down such that the effective corporate tax rate would be 15.5%. However, if you're an individual owning this foreign corporation, your effective tax rate, because of the higher individual tax rate, will be 17.5%. For your non-cash earnings and profits, so the plant and equipment or the other investments you've made in your business over that 21-year period, is also deemed repatriated, but it's taxed at a lower effective 8% tax rate. Though if it's individually owned, like our earlier example, you're taxed at a 9% rate. Now, if you're a business with virtually no cash on hand, this 9.5% is effectively payable on the book value of your business, so whatever value your business has grown to over the last 20 years. And if you are a large holder of cash, the amount is much higher. Now, the tax, of course, is payable when the owner's tax is payable for the 2017 tax year, with, mercifully, a special election to pay the tax over an 8-year period. And taxpayers who were unable to avail of this before the 15th or 17th of April 2017 have effectively been granted a year's extension to make this election. We're also going to look now at the taxpayer information reporting requirements. There are a number of filing requirements which affect U.S. expats. They also affect U.S. residents, but they're obviously not all U.S. residents will have these circumstances. The two most significant are Form 8938 and FinCEN Form 114, commonly known as the FBAR. Form 8938, these are fairly similar forms, so we're going to highlight some of the important differences. Form 8938, Statement of Specified Foreign Assets, is required for someone who is required to file an income tax return. If they're living in the U.S. and unmarried, foreign accounts with value in excess of $50,000 on the last day of their tax year or in excess of $75,000 at any time during the tax year must be reported. The allowances are doubled for married filing jointly and the same for married filing separately. If you are living abroad, your thresholds for the end of the year are $200,000 or during the year $300,000, again doubled for married filing jointly. The FBAR is required whether or not you're required to file a tax return. The question is whether you, as a U.S. person, so a citizen, a resident, or an entity, trust, corporation, LLC, with a financial interest in or signature authority over at least one foreign financial account, and that all of the foreign financial accounts have an aggregate value greater than $10,000 at any time during the year, and the residence of the taxpayer is not relevant. This filing must be made online through the Bank Secrecy Act e-filing system available from FinCEN. Like your taxes, a professional may file this for you. Now, one of the most important things about both of those requirements, but particularly the FBAR requirements, is the penalty for failure to disclose an account on your FBAR form can be 50% of the value of the account that wasn't disclosed for each year in which it wasn't disclosed without limitation. So you can see you could quickly wipe out the value of the account in only 2 years and be in extreme financial difficulty in a third or later year. There are many other reporting opportunities for U.S. persons. A U.S. person needs to file a Form 3520 or 3520A for foreign trusts or foreign gifts that are received that meet certain criteria. A Form 5471 with respect to certain foreign corporations. And this is tied quite closely to the definition of U.S. person, so a holding of 10% in a foreign corporation will require this form to be filed not only on acquisition but on a continuous basis. Form 8621, information returned by a shareholder of a passive foreign investment company or qualifying elected fund. A Form 8865 with respect to certain foreign partnerships. And a Form 8891 is a U.S. information return for beneficiaries of certain Canadian registered retirement plans.
Great. And then on this last slide that we've got some contact information for you as well as your practice and kind of as well as some other resources that we've got. We've got the Canopy community, which we hope you'll utilize as a resource to ask some of these specific questions. We've actually got some questions that we've run in the past for expat tax and got some firms that use Canopy that do that as well. We've got another course as well on FBAR certifications and some of those tests for when to file an FBAR and some of those things that Roger covered a lot, as well as other courses, and we will continue to add those courses on there. For you, Roger, any if like we mentioned, they can reach out to you and do that. Do you do consulting work with other practitioners as a course of business?
Yeah, absolutely. I'm happy to answer, straightforward questions. There's no charge for that. I'm happy to be a helpful colleague. But if it's a situation that you think needs greater in depth, happy to consult on it as well.
Yeah, for sure. As we get into it, and it's changing all the time. So keep an eye out. We'll probably end up having more courses and the like on this as the rules keep changing as they did not too long ago. So want to thank you for attending today, and we appreciate your time and hope that you'll check out other Canopy courses. Thank Roger for coming today and educating and doing such a great job. And we'll look forward to seeing you very shortly on a future webinar. Thanks so much.